Live from New York City this morning. Good morning, good morning. This Tuesday morning, session lows with 30 minutes until the opening bell. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York City, we begin with the big issue, the downgrades piling up.
We're looking at an economy losing momentum.
Look at what's happening to the real economy.
Getting increasing calls for a recession. Economists have begun to cut their top-down economic forecasts for GDP.
We did see some pretty notable downward revisions.
Input costs have risen substantially.
We're seeing demand destruction in some areas.
The consumer is on somewhat more fragile footing.
The earnings will start contracting in the second half.
If earnings crack, then that's the ingredient for potentially another leg down.
We do expect the Fed to hike rates more aggressively.
The economy is slowing, and the Fed is saying that's collateral damage.
The narrative is really going to be dictated by what happens with inflation prints and unemployment data.
Joining us now to discuss is G-Squared's Victoria Greene, Sam Lynton-Brown of BNP Paribas. And Victoria, we start with you. You do not think we have seen the lows this year in this equity market, that June is not the low for this equity market. Can you walk me through as to why you are so strongly convinced of that?
So something has to change, and something's going to have to break for the Fed to stop. So right now we're in the don't fight the Fed, and the Fed is aggressive. The Fed is hawkish and tightening and going to run off their balance sheet. And that's a very difficult environment for stocks and for growth. So when you look around, in my opinion, they're going to hike and hike aggressively until something breaks. So either inflation breaks over hard, not just that it peaked out, but it's like actually coming down from the 8 to the 6 to 4. And so it is not plateaued at the 6 to 8%. And then we also need to look at what happens to the labor market. So either labor breaks or inflation breaks. Until one of those two things happen, which is the only two things the Fed actually cares about, is a full labor market and inflation. Until something there breaks, I think the Fed is aggressive, and that's a very difficult environment.
It sounds like you're on the same page as Mark Cabana over at Bank of America. This is what he had to say earlier this morning, Victoria. He said to me and the team on Bloomberg Surveillance, we think we're probably only about halfway through the tightening of financial conditions that needs to take place in order to get inflation down. Victoria, he's looking for 4% plus on Fed funds. What are you looking for?
I mean, I think they may top out at 3.5. I think it's going to be hard for them. You know, we kind of get that break in August because nobody works in August, right? We all work in finance. Well, I'll be in Jackson Hole or Canada or somewhere nice and cool. So when we see September and we have the data in September, I think we'll have a little bit fuller picture. Are we peaked? Are we plateaued? What's happening to labor? I think 3.5 is about the terminal rate, maybe 4, but I think you're going to see something start to break. I think we're all very curious how June jobs came in, what the inflation numbers look like. You know, has inflation peak? Possibly. You've seen metals, you've seen oils, and you've seen gasoline come a little bit down off their peaks. I'm not talking substantial, but hey, 5 to 480 is a little bit of a difference on gasoline prices. I will say my only caveat that may stop the Fed sooner is if liquidity dries up. That's the only reason they rescue the markets. They don't care if Tesla and Apple go down in stock price. They don't care at all. That's not their job. They're not here to help you make money in the stock market. They may care if liquidity locks up in the credit market or in money markets. And so we're watching liquidity there and spreads, but I still don't think the Fed rescues anybody. And they certainly don't care if you're losing money in the stock market.
2 points there, in fact, more than 2, but 2 I want to come back to. One's the energy story. I'll get your thoughts on the energy equities in just a moment. Then I want to come back to the credit issue as well. Sam Lynton-Brown, great to have you back with us on the show, buddy. I know you're more constructive than most, and you sound more constructive than Victoria. So can you tell me why you think a lot of this cyclical concerns, the bearish cyclical concerns that you've picked up on, you think they're priced?
Thanks for having me back on, John. And before I disagree with some of the points that have been put forward, let me first agree with one, which I think is exactly as Victoria was putting forward. The Fed put's gone. And I'd go even further and to say that long put has now transitioned to a short call. So even if you're in the camp as we are, but the market already prices this type of shallow recession, and in order to have a bearish view on risk from here, you really need to be calling for a deep labor market recession. The type of ways that we like to express that more constructive view is through trade ideas that are short the right tail, things like ratio call spreads, which very much ties in with that macro theme that the market's gone from being long a Fed put to now being short a Fed call.
So Sam, where are you constructive?
global risk assets in general, we think we could be set up for a summer rally. Look, positioning and valuation is very bearish. The catalyst for that rally, I'd agree with prior comments from Victoria as well, need to come from the idea that central banks are at peak hawkishness. And I think we're seeing some elements of that already. We know that the Fed are going to be hawkish now. We know that they're going to be aggressively trying to tighten financial conditions. And given where the short-term trajectory for inflation is going to be, rhetoric will stay hawkish. But the market's more forward-looking than that. And we've already seen that type of price dynamic in recent weeks, where we've gone from a market focused on inflationary fears to a market more focused on growth fears. Expectations for where terminal Fed funds gets to in this cycle has gone from 4.1% when I was last on the show in mid-June, down now to 3.4%. And that's when the Fed have been very hawkish and where inflation surprised to the upside. So we're in a dynamic where I think the market can price peak hawkishness well ahead of central banks taking their foot off the pedal. And that in turn can provide a catalyst for this squeeze in what's now very bearish positioning, leading to a summer risk rally.
Sam, can that catalyst develop before you've actually seen the revisions to earnings estimates?
I think it can. The earnings estimates revisions, as you say, from bottom-up perspective, have some wax to adjust to the downside. But I think the market's absolutely not priced in line with what bottom-up earnings expectations are. So if you like, the degree of PE compression that we've had this year partly reflects a derating, but it also partly reflects that E is actually lower than people expect. And I think into Q2 earnings in the US, this really sets a low bar where the market could see downward revisions from bottom-up sell side for earnings, and yet the market could actually rally. And that would be, for example, the opposite of what we saw in Q1, especially in Europe, where the market interpreted the information as negative. Euro stock sold off, and yet all we saw from bottom-up analysts was upward revisions.
Futures right now down 1.3% on the S&P, about 15 minutes to go, 25 minutes to go until the opening bell. Busy week of data pushing ahead to payrolls Friday following a weak ISM print on last Friday, with the new orders component coming in contractionary territory. That is not good news. Mike McKee has more. Hey, Mike.
John, the recession story seems to flow this way. Consumers are concerned about inflation, so consumer confidence is way down and they're going to stop spending. But take a look at what's happening right now. Consumer confidence is way down, but Americans are not stopping spending. The data we got last week from the PCE numbers, this is the inflation-adjusted numbers, and there is a bit of a drop, but not much. And there's a huge gap between consumer sentiment and consumer spending. And I put the red line on there, the arrow, to show that consumer spending has basically maintained throughout the pandemic and kept going from on the same track as it's been on. So is the consumer going to roll over or not? That's the biggest question out there. Right now, the market's talking a lot about recession and talking about the Fed breaking things and pricing for something different. We have now moved off of a 75 basis point move in September to a 50 basis point move. If the market can move that fast, what about the Fed? The Fed could change its mind between now and the end of September. This is the week we got to worry about, though, and here's what you got to watch to see if that move in the Fed funds rate continues. Initial jobless claims, that's going to be your canary in the coal mine. Everybody agrees. If we start to see them significantly rise, then the June payrolls, of course. Look at unemployment and wages. We don't have recessions unless we have a big rise in unemployment. No sign of that yet. And then the St. Louis boys, Chris Waller, Fed governor, and Jim Bullard, the St. Louis Fed president, they've pretty much been aligned here in saying what they think is going to happen. And they were the ones who really predicted inflation coming, and the Fed would have to be more aggressive. So let's see what they're thinking. They both speak on Thursday.
Mike, before you go, I've had a ton of messages over the last week or so about the Atlanta Now GDP, nowcast, forecast, whatever you call it these days. Your thoughts on it? Deeply negative now, implying that technical recession many people are looking for. Can you give me your thoughts on how useful that particular data point is?
Well, it's an input. It's a model like so many others on Wall Street. And a lot of people on Wall Street have much different numbers than the Atlanta Fed. And the Atlanta Fed incorporates numbers as they come in, then has to extrapolate some. So really, it's working with data that just goes through May. We haven't seen the June data yet, and it could easily change. So at this point, it's probably not, put it this way, it's not a prediction. It's what would happen if the quarter had already ended and we knew what the numbers were. So I would not worry about that yet.
Some people worrying about it already. Mike McKee, thank you, buddy, as always. Credit Suisse cut their price target on the S&P to 4,300 from 49. Here's the quote from them. We reiterate our 22-23 EPS estimates. Our target is being adjusted lower to reflect the higher cost of capital on valuations, not recessionary concerns. Victoria, that's Credit Suisse. In your mind, what gets us to 4,300 from where we are right now?
The job market breaking and the Fed flipping over. The moment the Fed flips from hawkish to dovish, that would get us there. So if something breaks over the summer, then absolutely we could see that rally out. I just don't think the data is going to be that bad. You know, you looked around, we had 11 million job openings still. We're having this dislocation between people looking for jobs and the jobs that are available. I still think it's a really tough and tight job market. I do tend to think, you know, this would be a more mild recession. It's not gonna be an 08 or a 32. It's something that we can bounce back from quickly. The one thing I caution against, you're not bringing EPS down. I mean, we're all sitting here quaking in our boots about Q2 numbers that are about to come out. And I think it's going to be a little bit ugly under the hood. You look back at the pressures in Q2, and I think margins are going to be compressed. I think EPS could come down. You know, there's that great factoid, you know, Wall Street analysts are really reluctant to cut EPS forecasts. It's a very fast way to get fired. If you cut a forecast, then you're wrong. And so in 08, I think like we were anticipating a 15% EPS growth, even though the economy was already rolling over. So you got to understand a reasonably valued market depends a lot on the E, as my co-host suggested. And I think the E's are going to be under a lot of pressure right now just because of what happened in Q2. And so we want to look at, and we're seeing warning and guidance from CEOs. I haven't, and I can't quite recall right now, any CEO right now that's like, hey, everything's great. We're going to do wonderful in the second half of this year. And you got to take that and take that with a grain of salt and realize if your leadership is warning you that things could be rocky and you're seeing people say, hey, this might get a little worse, especially the banks and the financials, I think you need to listen to them.
Victoria, just a final question. Are you saying, and I think you're implying this, but I wanted to clarify, that the forward-looking side of things on the E is distorted by career risk?
Yeah, I think there's a lot of risk there, and I think it is hard for a lot of people to downgrade earnings because, you know, this is a short time period. We always talk about investing on a long time horizon. So forecasting earnings in an uncertain environment as consumers are changing the behavior, you know, Target's the poster child for that problem, right? They all of a sudden had this consumer spending shift. And as you guys pointed out, consumer spending is strong, but what they're spending on has changed dramatically. And so I think you're going to see potential pressures. You even saw Tesla missed on their deliveries and their delivery numbers fell in Q2. And so you have to look around and wonder, how did anybody really grow their margins in an inflationary tight labor market in Q2? I'm sure some did. Absolutely, there are companies that are going to weather this well, but earnings certainly could come under a lot of pressure.
Victoria, Sam, sticking with us. Your equity market breaking down by 1.3% on the S&P, going into the open in about 20 minutes away. Yields lower again for a fifth session. We're down 7 basis points on 10s to 280. 2s, 10s, just a couple of basis points. 2s, 5s, basically bang in line with each other, with some movers going into the open. Here's Taylor.
John, we'll continue sort of that risk-off mood that you highlighted. Start here with Tesla. Of course, we got the report on Friday that some of those deliveries were a little bit lighter than the street had expected. But I will caveat that with Dan Ives coming out with a note saying that a lot of this was well known. We knew about the COVID lockdowns. We knew about China's shutdown. April and May were light, but June was one of the stronger quarters. So again, with this stock, how much with Tesla are we thinking about backward looking versus forward and some of that reopening trade and maybe sort of that reopening of China? When you think about the demand side of things, though, NVIDIA certainly is one of those. Coming off of course, the Micron sort of forecast, the weaker than expected forecast that we had last week. How much of this is a demand story when we think about the chip space that is weighing on the sector? Metals as well, the third sort of line there on your screen. Our Bloomberg Commodity Metals Index down for a 6th straight week after 7 weeks of losses back in April and May. If there is one bright spot, though, it is Cowen TD Bank, of course, a report late Friday saying that they're looking at maybe a takeout or a buyout here of Cowen, that U.S. brokerage. Interesting comments here from the street, John. Piper Sandler coming out and saying that it could be attractive to the TD's ROE. It could be accretive there already. JMP Securities saying that based on revenue alone, that price could actually be in the $50 to $60 range. So the street rat saying it's reasonable at the right price. John.
Taylor, awesome. As always, Taylor Riggs with us through the opening bell. Coming up, top US and Chinese officials discussing economic policy.
Our economy is growing, but not without pain. Liberty is under assault both here and abroad.
Is the United States setting the stage to roll back tariffs on China? That conversation up next.
Our economy is growing, but not without pain. Liberty is under assault both here and abroad. In recent days, there's been reason to think that this country is moving backward. I want you to know we're going to get through all of this. From the deepest depths of our worst crises, we've always risen to our higher heights. We've always come out better than we went in.
The President of the United States, the US and China holding talks amid reports that the White House is considering easing tariffs. The Treasury Department writing the following. During the candid conversation, they discuss macroeconomic and financial developments, the global economic outlook amid rising commodity prices and food security challenges. For more, let's get to AMH from the White House. Anne-Marie, let's start there. The prospect of removing tariffs on Chinese goods.
Well, John, we should be clear. The administration has been debating this for literally months. Now, potentially, we could get an announcement. The president himself said he would have an announcement soon last month, as well as also highlighting that he'll potentially be speaking to his counterpart Xi Jinping. But now you are seeing a number of meetings fall into place. We had Jake Sullivan recently meeting his counterpart. We have now Secretary Yellen on the phone with China's vice premier. And just in the last hour, we learned that Secretary Blinken will also be meeting the Chinese foreign minister on his upcoming trip to Indonesia. The issue the administration has is that it is divided. There are some, like Secretary Yellen last month, saying that they want to reconfigure some of these Trump-era tariffs. Will be on everyday, commonplace merchandise. And then you have others, like Ambassador Tai, saying that these levies are a force of leverage and that what they would take away in terms of inflation will be marginal. Barclay says it's about 0.3 of a percentage point. So the president, Jonathan, who will make the ultimate decision, needs to decide at this moment with midterm elections in November, does he want to be seen as potentially soft on China, which what Republicans will come out and say if he lifts those tariffs, or if he lifts them, does he want to use that as a spin to say he is doing everything possible to ease inflation, even though it's potentially going to be very marginal?
That is a really, really difficult needle to thread.
Yeah.
Anne-Marie from the White House, AMH, thank you, and good to have you back stateside. Looking back to Europe, where Anne-Marie's just come from, euro-dollar 102.77 and negative 1.4%. Sam Lynton-Brown, we've got to talk about the single currency breaking down here. You're constructive on parts of this market. Can you be constructive on that?
Can't today. It's a very significant break. We've gone to near 20-year lows. And importantly, this is quite an FX idiosyncratic move. So while it's directionally consistent with what we've had in other asset classes today, underperformance of European risk assets, higher natural gas prices, a retracement in core yields in Europe, the FX move in magnitude is much bigger. So this likely reflects some large idiosyncratic flow hitting the market. It's taken us through that key level. And in terms of fading it in the very near term, independent of what your medium-term view is, I think that would be unwise. Now, for me, the question is, well, if you want to go with positive dollar momentum, given the magnitude and the significance of today's technical break, where are the attractive ways to be positioned? We actually think euro-dollar is not the most appealing. This is for a number of reasons, but primarily long-term valuation is likely to result in some buyers at these levels that fade any decline. So I'd focus on two other currency crosses and pairs. The first is Euro-Swiss. I think this can break down materially. We've already taken out parity today, and we think it can head down to 96. Aside from the Eurozone growth risks that the trade catches, it also puts you on the right side of what, in our view, is a very material pivot, very material shift, I should even say, from the S&P. Second trade is cable. We've broken through 120. We think that can absolutely extend. Our view can be that you can have euro-dollar stable at these levels, but euro-sterling rising to 90. So for a dollar momentum trade, we think cable is more appealing. euro dollar.
Euro Swissy at 96, that's brutal. Right now what we're seeing on the single currency is brutal, and the relationship between what's happening with Europe and energy is pretty clear for all. Victoria Greene, there's a question that a lot of people have got on the energy side of things. I know you've been constructive. I know you've been thinking about buying this weakness. Devon's 30% off the June highs. Can you walk me through, just help me understand, how in a world of decelerating growth, potentially recession, that the energy trade will continue to work?
And we have kind of pulled that back a little bit on our bullish call. Absolutely. We took some profits end of June. We are still overweight versus the benchmark in the energy sector. And you saw a little bit some of the questioning of where crude's going to end up. You got JP Morgan with 380 and Citi with 65, right? We have this like huge bifurcation of where crude may run. And there's a lot of factors. Number one is, what is Russia going to do? Are they going to, the cap is not going to sit well with them. There's concerns if the Nord Stream shuts down in Germany, they're never getting it back open. And you're seeing in a little bit, I think that ties in with the currency play. Energy producers, and we're very strong. Our economy, we're in a rising rate environment, and we produce energy. Energy consumers, your Japan and your Europe, you're seeing their currencies come under some pressure, and there's definitely a potential of an energy crisis in Europe, depending on how all this plays out. So if you're looking through your scenarios, we always go with what's the highest probability scenario, which I know it might be asking a little much, but I tend to think we're going to have rational actors. So we're not going to see crude to 380. We also don't see a severe recession. The crude 65 is also extreme. So I generally still like the energy space. Again, we did lighten up the positioning a little bit, took some of the profits, because in investing, it's never a profit till you actually sell it, right? So we did want to lock in some of that, but we see inflation and crude staying high because of geopolitical risk. Now that's a wild card with Russia, what Saudi Arabia does. You know, if we're talking to China, are we going to talk to Iran?
Very good point. Victoria Greene, Sam Lynton-Brown, to the two of you, thank you. Euro dollar, session lows right now, 102.68. Up next, the morning calls, and later, Peter Tchir of Academy. Equities heading lower. Here are your morning calls. First up, Citi downgrading Sony to neutral, highlighting macroeconomic risk and a potential drop in valuations. Piper Sandler lowering its price target on Netflix to 210, citing subdued user growth. And finally, JP Morgan lowering its price target on Tesla, 385, expecting production to take a hit. Coming up, the slowdown story weighing on equities. Academy's Peter Cheir turning bearish. He joins us next with your opening bound just around the corner, and futures down 50. We're negative 1.3%. Equities negative here. Good morning to you. We're down 1.3% on the S&P 500. On the Nasdaq, we're down by a similar amount. We're down by 1.4 on the Russell. The small caps even lower by 1.65%. That's the equity picture. It's a negative one. It's session lows going into the opening bow from New York City this morning. Good morning. There is your opening bow. Let's talk about things cross-asset. Let's talk about this bond market. 5 straight days of yields lower. We're down 7, 281.27 on a 10-year this morning. The difference between 2s and 10s, just a single basis point. The euro is where a ton of pain is. 102.65. You've got to take the chart back to 2002 to see these kinds of levels. 102.67 and negative 1.5%. WTI crude 104.25. We're negative 3.9%. That is a turnaround in the last couple of hours or so. But the bond market for me is the main event outside of foreign exchange. In the bond market, we're seeing the spread between 2s and 10s get narrower, the curve get flatter, and we're seeing the bond market respond to weak economic data. Yields lower for 5 straight sessions. On 10s at 281, on 2s at 280, and we'll have a big conversation about what's happening in the credit market outside of Treasuries a little bit later this morning with Peter Tchir of Academy, and what that will or will not mean for this Federal Reserve. At the open, about a minute in, let's get you some movements. We can do that this morning with Katie Greifeld.
It's another ugly day
for tech already, and particularly for the chip stocks. Micron was the big loser on Friday. Today, it's AMD falling over 2% from the opening bell. JP Morgan also under pressure. John, I know you're watching that yield curve. Like you said, the 2-10 spread just about 1 basis point away from inversion. That's bad news for the banks, bad news for JP Morgan, down over 3%. Travel stocks, no picnic either. You can see Carnival down 5.5% after just a terrible week last week, falling again today, along with just about everything else in the sector. Cowen, though, it's your rare bright spot, up over 16% after that late Friday news that TD reportedly exploring a takeover. Analysts this morning broadly positive on that potential merger in commentary. And John, I do want to quickly hit on Ford, because this headline crossed at 9:15 that Ford U.S. sales were up 31.5% year over year in June. And we know that Ford is betting big on EV pickups in particular. GM and Tesla not expected to compete in that space before 2023. That gives Ford a little bit of time to grab a foothold there. Currently, EVs make up just 2% of Ford's sales. But John, that's expected to be 40% of sales by 2030.
That stock is down about 4%. Katie, thank you. Good to see you, that's for sure. Euro dollar, not good to see this. That chart just breaking down even more, down 1.5%, 102.63. Nomura and Jordan Rochester earlier this morning publishing this. Today's move lower in euro dollar, thanks to Norway's gas strikes, new highs in German electricity prices, is just a warning as to what might materialize. Their numbers they're looking for now, 98 on euro dollar, 98 and maybe even 95. Right now, 102.66, and numbers we haven't seen since 2002. That's the FX story. Looking ahead to earnings just next week, July 14th, you'll hear from JP Morgan. Before that, here's a data point for you. CPI next week on July 13th. Before we get there, we need to deal with payrolls this Friday. A lot to think about, Taylor Riggs, a lot to think about through the next couple of weeks.
And how much does that fold into the dollar strength story that you just mentioned, right? Sort of the defensive nature of this rally. And that really sort of is highlighted here when we take a look at cyclicals versus defensive, and how sort of classic this chart is. With cyclicals, you're still down 26% when you think about where we are year to date, just over 6 months into the year. The defensives only off maybe about 4% or so. Earlier coming into this morning, that number was less than 3%. So it's an underperformer, but on a relative basis, is still outperformer, if you will, when you think about the defensiveness of this. The next chart is a classic Dan Curtis chart. We're doing standard deviations, John, at 9:33 in the morning. On a standard deviation in terms of upside surprise, the household sector, the consumer, actually better than expected. Down at the bottom, housing, worse than expected when you think about where we are relative to consensus coming into this year. And if you change up the board again, you really see this. How much of this has been a rate story? Of course, today yields lower on a risk-off trade. But year to date, we're looking at mortgage rates rising, new home sales rolling over. But how much of this is exactly what the Federal Reserve wants to see in terms of making maybe the consumer feel less likely to buy, slowing down the overheated housing market?
Taylor Riggs, thank you. We'll catch up with Taylor again in just a moment. And Taylor hit the nail on the head. This is what Mike Schumacher of Wells Fargo said last week. This is a feature, not a bug for this Federal Reserve. This is the goal, the objective. At what point, where is the tipping point in this market where it becomes a bug and not a feature? Seemingly not now, with high yield credit spreads at around about 580. Is it 600, 650? Is it about the price? Is it about supply? Is it about liquidity? I guess if we carry on pushing it, we'll find out. About 4 or 5 minutes into the session, we're negative 1.7% on the S&P. Every single industry group on my screen right now is negative. Energy's down 3 percentage points. Materials down 3%. Katie did a great job of bringing up JP Morgan. Financials down by more than 2%. Staples down 0.4. The overall benchmark, the S&P, down 1.7. Taylor mentioned some of the house builders. The home builders year to date on the S&P down 33%. And Peter Tchir of Academy is sounding the alarm on housing. He says the following: I'm told that housing formation supports home prices. Scarcity remains an issue. All cash buyers make up more of the market, and all sorts of other reasons why housing prices cannot go down. But I see the combination of rapid price acceleration and the gap higher in financing costs as a toxic mix. Pete, I'm pleased to say, joined us right now. So, Pete, let's start there. How big a problem do you see?
I see actually a very big problem. I think we really have to start thinking about the wealth effect, right? We're not hearing much talk about wealth effect, but if you look at this year, stocks have been horrible, bonds have been horrible, crypto's been horrible, and I think we've seen a turn in housing. And I just think that is going to accelerate the problems, and that we are so leveraged as a financial system to rates that people are underestimating this mix of, how each thing interacts with each other. And I expect a really horrible summer in terms of the data deteriorating far faster than people expect.
Let's put some numbers on that horrible data that you forecast. Pete, you know the consensus now, if we get a recession, it'll be short, it'll be shallow. Are you pushing back against that?
Yes, I think it'll be deeper and longer. Again, until the Fed really switches and gets off fighting inflation at all costs, I think they're missing all these little hints that there's problems in the economy, whether it's inventory builds, whether it's housing starting to slow down. And then the wealth destruction that you've seen in crypto and in terms of disruptive stocks is really twofold. One, it's hit the individuals who own those companies, were part of those companies, who were getting paid by those companies. But I think the next wave is the spending that was done by those companies. When people didn't care about cash flow positive, right? If you could just spend and it was all about potential future growth, there was a lot of excess spending being done by those companies. I think that's going to hit very quickly too. So I think we're in for a double whammy. And I keep having visions of Wile E. Coyote, with the Roadrunner just hitting a wall.
Pete, I wish it was that entertaining. Unfortunately, the picture you're painting is a pretty dreadful one and might be scary for some people. Typically, when we talk about the potential depth of a recession, we'd look for excess. You're speaking to that. We'd look for the breadth of that excess, and we'd be talking about leverage. Where is the leverage? How big is that leverage? Pete, that's why some people are pushing back and saying it'll be short, it'll be shallow, because this time around, it's hard to find the excess on household balance sheets and corporate balance sheets. Do you push back against those 2 points too?
I do. I think we're not going to go into a great financial crisis. I think people's balance sheets are in much better shape, but we've become so used to this high level of spending, and we still haven't been able to separate how much of the spending that occurred was due to, government stimulus, right? We had so much government stimulus. You also have this issue that, okay, bank accounts are very flush, but a lot of people didn't pay their rent or their mortgage payments or their student loans. So I think there's a real balance, and I think things are more precarious. And if you dig deeper into the system, I think there's a lot of imbalances that are starting to come out. And we'll see that accelerate. Again, I'll go back to crypto, right? A few weeks ago, it was what price it is. Now it's about which companies are going out of business. Can you get your money out of accounts, right? So this narrative has changed, and it's changing very quickly. And I think we're just going to see that across the board.
Pete, why do you think that pocket of excess in crypto is sufficient enough to make a call that this could cause big problems in this economy?
And I just highlight this as maybe as the tip of the iceberg, but this time around, right, crypto's dropped 60 some odd %, but to me, you've probably lost about $2 trillion. And that was relatively new wealth that was created. It was almost found money. So I think people were very happy to spend that money. That money was also, spread around various tech companies. Those tech companies have gone down. The people who had stock options in those tech companies, whether they were 5 million, 10 million, expecting to be 15, 20, 30 million, right? People were buying houses in cash because they didn't care. And now with this kind of across the board wealth destruction, people are turning about A, how do I preserve my wealth? B, will I still have my job? And that's a very different narrative. And I think you're just seeing spending change very dramatically, very quickly. And it's because now people have to go back and think about wealth preservation. I think that's for individuals and companies.
Pete, I wonder when this puts the brakes on the Fed's goals and how far they can take Fed funds. Take a listen to what Mark Cabana of Bank of America said this morning.
We think we're probably only about halfway through the tightening of financial conditions that needs to take place in order to get inflation lower and for the Fed to feel like they can declare victory in that backdrop.
Pete, he made 2 big points here. One, we're only halfway through the tightening of financial conditions. And 2, he thinks the economy is resilient enough that the Fed will have to take rates through 4%. Out of those 2 points, what do you agree with the most?
I guess on the economy, but I think we're not going to get anywhere close to 4% on hikes. I think long before November, the politicians are going to start realizing that a slower economy is far worse than any inflation pressure. I think the narrative out of DC is going to change. I think there's going to be political pressure, and everyone's going to talk about, wow, who cares about inflation if we start losing jobs, if spending starts going down, if GDP is decreasing, right? All you have to do is go back to Bush Sr. to see how important the economy is to get reelected. And I think that's going to be the narrative that shifts. And I think it's going to shift very rapidly, and they are going to regret their hikes, as early as August.
Is that the point that you want to buy this weakness? We're down 1.8% on the NASDAQ, down 1.9% on the S&P. You're seeing that classic race to the US dollar with euro dollar at 102.60. Is that the point at which you think some of this turns around, Pete?
Yeah, I would like to see maybe another 5 to 10% pullback. I'd really like to see some of these, high-flying ETFs like TQQQ, which is a triple leveraged QQQ, really see outflows. That to me would be the signal, okay, people have kind of given up and now is the time to step in and buy. I watch Eurodollar to maybe bottom. I like some of the calls that you were talking about earlier, whether it's 98, 95. And I think what's really happening is people are realizing Europe is in deep trouble. Europe is headed towards a recession. once that gets priced in, then I think people start realizing, wow, how far behind is the U.S.? And that's when we start seeing a big reversal. That hopefully is kind of the washout that we need in U.S. equities to become a real buyer. Or we need some signal from the Fed that they are going to ease off on their both quantitative tightening and or rate hikes.
So, Pete, I just wonder, is it too early to see it in this earnings season if you're expecting some of this to really climax later in the summer?
I think it's probably too early to see in this earnings season, though I think you're going to start hearing a lot more about warnings, and you're going to hear about spending cuts. And it's the spending cuts that I think will be as important to triggering a wave of selling as it is going to be the earnings warnings.
Peter Tchir of Canary is going to be sticking with us. Some big calls here. He's looking for more downside in this equity market, maybe another 10%. I think if you are looking to buy this market, it makes sense for Pete to say, I want to see that before I buy. But ultimately, he's looking for some real economic weakness as a catalyst for some of that extra downside. Right now, we're down 1.9% on the S&P. On the NASDAQ, we're down 1.7%. Talked a lot about this move in euro-dollar. It's a real break, a break of numbers we haven't seen in a long, long time. To see a sub 103, you've got to go back to 2002, 102.67, and down by 1.5%. Heavily weighted, of course, a single currency on the dollar index. DXY, 106.50, 106.50, and still the commodity market looking at numbers a little something like this right now. Brent and WTI north of 100, but only just as we break down there too, by 5.7% on Brent to 107, on WTI to 103, down about 5 percentage points on the day. Coming up, conflicting calls on crude emerging on Wall Street.
I would argue even in a pretty deep recession, I just don't see oil prices going below $80, maybe even not even $90 because of years of underinvestment.
That conversation up next.
We still see Russia acting as a rational player in the market, both for oil and for gas. It doesn't mean that energy doesn't get weaponized. I would argue even in a pretty deep recession, I just don't see oil prices going below $80, maybe even not even $90 because of years of underinvestment. Nobody's actually able to raise production very much.
When it comes to forecasts, predicting crude prices is probably one of the difficult jobs out there, the most difficult jobs out there on Wall Street. The strategists right now all over the place. Citi on the one side, wanting crude could collapse to 65 a barrel by the end of this year. JP Morgan came out with this scenario, seeing the potential, I stress potential, for prices to rise to an all-time high of 380 if Russia cuts output. Taylor Riggs has more. Hey, Taylor.
And that is the conundrum. John, I really wanted to focus on the downside call from Citigroup looking at 65 if there is a recession. It actually, and now maybe over $100 a barrel seems pretty far off, but you go out a few months, that is the December contract all the way back down now to just 91, 92 a barrel. So maybe not that far out when you're thinking if there is a recession by the end of the year. That is the call for 65 now, just about 92. A lot of this, of course, does bank on if there is a recession. We really have to do some historical analysis here. When you think about 08 and 09 and the global financial crisis, we went from 90 to 70. You bottomed out at 35. Don't get me started about 2020 with a huge demand issue. And then we saw some negative prices briefly there. But again, sort of settling out in that $30 range before really coming up here into sort of beginning of this year into back to the triple digits. I think what is so interesting when you think about where we are at about an average in the second quarter at 108 this year, price per gallon is $5. And John, this is the conundrum. Are higher prices the cure for higher prices? Do the consumers start to push back? How much of that is baked into this call as well?
Right now, Taylor, there are some big problems off the back of some of this in Europe, not just crude, but gas too. Taylor Riggs, thank you. And a big move in this German bond market, down 16, 17 basis points at the front end to 43 on 10s right now, down 13 to about 120. Do you remember when we got close to 180? It wasn't that long ago. Right now, 120 on a German 10-year. The economy minister out of Germany had this to say after putting together a bailout package for struggling energy companies. We will do everything to keep up the basic supply in the coming winter and to keep the energy markets running as long as possible. Matt, and it's good to have you back, mate, as always. Matt Miller, they are not the things you want to say as a politician, are they?
No, and especially not as a green politician, right? You don't want to encourage the use of fossil fuels, which Robert Habeck may have to do. in order to get anything through politically. Now, the plan right now is to pass on higher costs. That should be a way to deter usage, right? But also this $9 billion bailout of Uniper, spending money at a time when the German government really doesn't want to have to do that. So we've got this issue at the same time as the euro comes down to below $1.03, right? We saw $1.02 this morning, the lowest level since 2002, which was really the very beginning of the usage of the euro in public by consumers. And at the same time, you've got a trade deficit for the first time since 1991. That's basically when the wall came down, like a year after the wall came down was the last time you had a trade deficit, because Germany typically builds and sells many more things than they buy. The problem is they sold 0.5% fewer things in the last month than they did in the same month the year before, and they bought 2.7% more things than they did last month in the same month a year ago. So they're seeing a higher trade deficit, they're importing inflation, and they have this lower currency that should theoretically allow them to sell more stuff, but they just can't do it, especially without chips, to get their all-important cars on the lot and out the door.
Matt Love this morning. Thanks for the extra shift on Bloomberg Surveillance. Thank you, mate. Matt Miller there, breaking things down out of Germany. Peter Tchir, I'm just going to keep it straight and open for you. What's developing in Europe right now, Pete, from your perspective? How bad is this going to be?
I think it's going to be very bad. I think you're seeing this energy crisis play out. I think you have a slowing economy. You have this displacement of people. You've got food crisis potentially there. So I think Europe's going to be very bad. I think you're seeing the U.S. going to follow suit. So again, it keeps coming back to me that there's this recession. And I do like the one other point someone made, I think, was we're looking at energy and where we stand in inflation. To me, there's three threads to pull. One is recession. What does that do to energy prices? What's that doing? Two is, have we really shifted to this kind of global commodity war? And I think that really is a global commodity war. I know we've discussed it before, where I think what you have is China and these autocratic commodity-rich nations aligning to secure commodities. And that's left us out a little bit in the proverbial cold. And we're going to have to figure out what to do about that. And the third part of that thread, or the third thread really, is what are we going to do about energy domestically? I believe that we have to build out sustainable energy faster than we're doing. I also believe that we have to spend a lot of money and reinvest significantly in traditional energy. I really thought we would see some of this the day after Russia invaded Ukraine. And here we are, months and months later, and we're still not doing much. If anything, we're still causing friction between the energy companies and our need for production. I need to see a plan. I want to see DC come up with something that puts us on a 5 to 10 year plan towards energy independence. And then I can get more comfortable.
Pete, final one from me. High yield spreads breaking out pretty much all of last week, pushing 600 basis points in and around 580. You've talked to me about that tipping point in this economy. Before we get there, you'd imagine this market starts to pick up on it. How much wider do you think those spreads are going to go?
No, I think they can go a little bit wider. I really do think, though, this time it's going to be led much more by equity. So I think credit's going to outperform equities pretty significantly. Though for high yield, I'm always watching the Russell 2000. That's the correlation I look for there. On investment grade, I watch versus the S&P 500. I don't see the leverage in the system. I think you're going to see a little bit of weakness. You're seeing leverage loans. In fact, if anything, I'd probably be a little bit more concerned about leverage loans than the high yield bond market, because I think the high yield bond market over the last 10 years has matured. It's more, public in terms of the companies there, the information available, and a lot of the deals that might not have got done in the past kind of found their way into the loan market. So that's probably where I'd keep looking for that canary in the coal mine to see if you start seeing a breakout there.
Pete, thank you, sir. As always, Peter Cheir there of Academy. Just looking at this market at the moment, still breaking down. About 23 minutes into the session, we're down almost 2% on the S&P. We're down 1.6% on the Nasdaq. Looking at the bond market right now with a strong bid in Germany, down by more than 10 basis points right the way through the curve. 2s out to 10s. 10s right now in the US down 6 basis points. The 2s are down 2. And the difference between 2s and 10s is fewer than 1 basis point right now. 0.7 basis points. A lot to talk about, a lot to look ahead to. Your trading diary up next. Twenty-five minutes into the session stateside after the long weekend. Welcome back. We're down by 2% on the S&P 500. On the Nasdaq, we're down by about 1.5. That's the equity picture. The bond market story. 5 straight days of Treasury gains, yields lower, down 6 basis points, 281.63. risk aversion, a story out there. That's the headline. That's the price action. Here's your trading diary data in just a moment. Durable goods, factory orders, top of the hour. We'll get Fed minutes on Wednesday. The ISM, services, some PMIs, jolts, job openings. Take your pick. Tons of data. Initial jobless claims. Another round coming up on Thursday. Then the big one this Friday. The main event. It is payrolls Friday, and the median estimate so far is 273. In a Bloomberg survey on my screen right now, 390, the previous number. From New York, this was The Open. This is Bloomberg TV.